Hi, welcome to the class of this week. As we have learned in the earlier chapters, the oldest business of investment banks is to help governments and companies raise funds by selling securities to the general public. In this chapter, we will be discussing the most representative business of investment banks, capital market financing. Here, we define capital market financing as long-term funding through the issuance of securities in a regulated market. We have three keywords here in this definition: long-term, issuance of securities, and a regulated market. Long-term funding refers to funding with maturity of more than 1 year. Examples of long-term financial products are bonds, stocks, and hybrids. The term capital market is relative to money market, where the latter is characterized with short-term funding instruments with maturity of less than 1 year. Examples of short-term products are commercial paper and treasury bills. Our next keyword is issuance of securities. Securities are exchangeable, fungible, and standardized financial instruments representing financial value. Our last keyword is a regulated market. A stock market exchange, such as the New York Stock Exchange, is an example of a regulated market. A company may raise funds by selling its equity to private investors too. For example, Huawei Technologies raised funds internally by selling company shares to employees. The company was owned by 96,768 employees in the early year 2019. Example is not considered capital market financing. Next, we will introduce more about security issuance in the capital market. Capital market securities are issued on the primary market. The primary market is the market for newly created securities. The newly created securities are underwritten by investment banks and sold to public investors. The proceeds of money raised in the primary market will go to the issuer of the security, i.e. the firms. After primary market issuance, the securities then trade on a secondary market. A secondary market is the place for investors to trade previously issued securities among themselves. Secondary market trading has no impact on total shares outstanding. Transaction price of stocks on the secondary market also do not influence the amount of money raised by the issuing company. Once secondary market trading starts, the trading price usually fluctuates away from the issuing price. The term IPO, or initial public offering, refers to the first-time issuance of shares to the general public. Investment bankers help the issuing firm with many details of an IPO, including deciding the timing of an IPO, the size of funding and the pricing, preparing legal documents, marketing, and selling. To date, the largest IPO ever recorded globally is the Alibaba IPO on New York Stock Exchange on September 19, 2014. A total of $25 billion worth of shares were issued. The Alibaba IPO was underwritten by several global investment banks, including Credit Suisse, Deutsche Bank, Goldman Sachs, JP Morgan, Morgan Stanley, and Citi. On the first day of trading, its share price experienced a 38% increase from its issuing price of $69 to $93.89. Investment bankers also help raising funds for firms that are already listed on the stock exchange. A sale of additional shares of a firm that was already publicly traded is called SEO, or seasoned equity offering, and this is also known as follow-on offerings. Both IPO and SEO are examples of primary offering, where new securities are created and the raised funds go to the issuing firm. Another type of issuing, or secondary offering, does not have any impact on shares outstanding. Secondary offering, or secondary market offering, is the sale of large blocks held by large investors to the public. The blocks being offered may have been held by private equity investors or management with lock-up period. Those block holders may choose to sell their shares in the open market, but secondary offering gives them the opportunity to sell at a fixed price to the public. In a secondary offering, any proceeds of the sale go to its holder, not the issuing company. An example of this type of issuance is the secondary offering of Block Meat, the man-made meat manufacturer. In July of 2019, block investors of Block Meat, including Bill Gates, cashed out their shares of the company through a secondary offering. The offering price is 6 times its IPO price. Its underwriting banks include Goldman Sachs, JP Morgan, and Credit Suisse. New shares are sold to the public through the underwriting efforts of investment banks. Investment banks can complete its underwriting function either on a best effort basis or on a firm commitment basis. In a best effort contract, an investment bank uses its sales network to help an issuer sell as many shares as possible. In firm commitment contracts, also known as bought deal, investment banks buy the entire issue at a discount and attempts to resell it at a higher price. The gross spread represents compensation for the bank. Bought deal guarantees the sale of the stock. A standby commitment is sometimes used in other countries. For example, a standby commitment is the dominant way to issue a security in the market of China. In a standby commitment, an investment bank would first help an issuer to sell its shares to the public. If there are any unsold shares, the bank would purchase the remaining portion of the unsold shares at a specific price. Underwriting business can pose risks for investment banks. Investment banks are subject to considerable security price risk in a firm commitment contract. But under the pressure of industry competition, investment banks would often agree to bought deals. During the IPO of Alibaba, its underwriters purchased more than 368 million numbers of shares. Stock issuance in the market of the U.S. followed a registration-based system. In a primary market offering, information regarding issuer and the security being issued must be provided to regulators and prospective investors through filing with SEC, unless otherwise exempted. As we have discussed last week, under the regulatory framework of Securities Act of 1933, issuers and investment banks share civil and criminal liabilities in information disclosures. For example, investors can sue the banks to repurchase their shares at the original price. Stock issuance in the market of China follows an approval-based system. The issuers are required to make public disclosures, including the filing of prospectus, valuation reports, and auditing reports. In addition to information disclosure, all IPO applications are subject to approval by the China Securities Regulatory Commission. The government authorities reserve the final right to decide an IPO. In year 2019, Shanghai Stock Exchange launched the Sci-Tech Innovation Board, which is also known as the Star Market. This marked a pioneering step of China to test the registration-based system. Okay, thanks for watching. In our next video, we will have a more detailed discussion of IPO business.